Hi, everyone, and welcome to today's webinar, 2026 in Focus Market Outlook and Asset Allocation Strategies. Thank you for joining us this morning. We're going to begin today's session with a short video that we recorded earlier in the week, where I sat down with Tony and David to discuss their asset allocation document that they released earlier this month, as well as some of the broader macro themes that we think will be shaping the year ahead. Following the video, we'll return live and David and Tony will help answer as many of your questions as we can. So if you'd like to submit a question during the session, please use the Q&A function on your screen and we'll endeavour to get through as many of those as possible. For any that we don't have time to cover today, Tony and David will be visiting our Melbourne, Brisbane, Perth and Adelaide offices over the coming month for some sessions with advisors and clients. So hopefully we'll be able to see you at one of those as well. But thanks again for joining us this morning, and we hope you enjoy the session.
Welcome to Canaccord Genuity's 2026 Market Outlook webinar. I'm Daniel Veazey, and I'm an analyst here in the Investment Strategy Group at Canaccord Genuity, and I'm joined this morning by our Co-Chief Investment Officers, Tony Brennan and David Cassidy. Tony has over 20 years' experience in investment strategy, working for major investment banks across New York, Sydney and London. Prior to joining Canaccord, his roles included working as Head of Investment Strategy at Citi Australia and also Head of Investment Strategy at Deutsche. In addition, Tony has training as an economist, having begun his career at the RBA. David joined Canaccord following the acquisition of Wilsons Advisory in October 2025 and has extensive experience in analysing markets from both a top-down and bottom-up approach. Prior to joining Wilsons, David's roles included a role as Head of Investment Strategy at UBS Australia and also included various roles at JP Morgan, including Head of Investment Strategy. David, if you don't mind, I might pass over to you for the first question this morning. We've recently released our first quarter asset allocation outlook. We maintain a broadly constructive view on equities, although we have seen a bit of volatility to start the year. Could you just walk us through that view in a little bit of detail, please?
Yeah, sure, Daniel. So we are still constructive on equities. At the moment, we have what we call a neutral view on equities. So we think this year we're likely to see more normal returns from equities as an asset class. Obviously, very strong returns over the last 3 years. So from that perspective, something a little bit more moderate. In terms of the detail of that view, we're moderately overweight global equities and moderately underweight Australian equities. But really, the key message there is we want to stay invested in equities. Beyond equities, underweight fixed interest and cash, and balancing that up with an overweight in what we call alternative investments. So if I just broadly encapsulate the big picture story at the moment, we think the macro environment is still good for growth assets. So US growth is good, global growth is quite solid, and anything getting a little bit better. So from that perspective, we still like growth assets. And I think importantly, the Fed is important. It's likely to cut interest rates again in 2026. And typically, if you've still got growth and the Fed's cutting, equities do well. So from that perspective, we want to stay invested, but we are pretty well diversified at the moment. So we're dealing with tail risks more through diversification than any overt tilt away from equities in terms of our broad asset allocation.
So Tony, maybe just in terms of recommending that moderate overweight to global equities, could you maybe just expand on that view a little bit in a little bit more detail for us, please?
Yeah, thanks, Daniel. The backdrop this year, as David mentioned, is that we have had a lot of good years of returns in equities. And in particular, a lot of that has been driven by the US market, which has been phenomenal. But last year that changed a little bit and we got more widespread performance across the rest of the world, which actually, for the first time in quite some time, possibly a decade or more, exceeded the return of the US market. So, that informs our view a bit, the fact that we've had so many good years. The US market, of course, as a result of all that performance, is at a high valuation. And we've seen this past couple of weeks that is causing volatility. A lot of that valuation is in the big tech stocks, phenomenal companies, but at high valuations, you do get a bit of volatility. And, but of course, the growth of those companies is still very good. On top of that, the broader market, which is, the rest of the industries across the country, aren't as at as high valuation. And they're in a reasonable position to potentially take up some of the leadership of the market this year in the US, particularly as the economic backdrop that David mentioned is pretty strong. So that's encouraging. And then over and above that, when you look beyond the US to the rest of the world, because they haven't performed so well for so long, the valuations there are actually quite moderate. And that was a big factor last year in what contributed to the returns in places like Western Europe, Britain, Japan, the emerging markets. And so there is the potential for another year like that because those economies are looking a little brighter. Last year, they had to cope with tariffs coming out of the US. They've done that quite well. And the other influence affecting markets at the moment is a bit of a desire to diversify away from the United States because the predictability of the country has perhaps diminished a bit. And we see a potential for that to actually further lift other markets, but not necessarily weigh on the US so much, but lift other markets and their currencies. So with that, we might have a different pattern to the performance, but we still see some reasonable returns this year.
David, maybe if we turn our eye to the domestic market, we still think that the index can push a little bit higher this year, but we're maybe a little bit less constructive than on global equities. Could you maybe just expand on that view for us, please?
So I think the issue with Australia, I think, is we're a little bit concerned that you won't get the same level of earnings growth in Australia through 2026 and possibly 2027 as you do get globally. So from that perspective, that tends us to keep us a little bit underweight Australia relative to global equities. I also think if you look at the macro environment, whereas the Fed is expected to continue easing through this year, we've had quite a significant shift in what the RBA is expected to do relative to just a few months ago. So the prospect of a couple of RBA rate hikes this year, I think what they're looking to do there is slow the economy, and that does have implications for earnings growth. So even though earnings growth overall is picking up in terms of what the consensus thinks over the next 12 months, a lot of that's from the mining sector. If you look domestically, you're probably not going to get that pickup. It might even get a little bit of a slowdown. So that's where we're really coming at our underweight position from. Also, the strong $8, that helps the relative performance of Australian equities when we think about Australia versus global, but the $8 strength is a little bit of a headwind for earnings as well. So from those perspectives, we think, as you say, Australia should be up this year as a base case, but at the margin, liking global equities a little bit more than Australia because of those headwinds.
Righty, Tony. Now, that shift in RBA policy that David just mentioned it's a nice segue, but that will likely have some implications for fixed interest assets. Could you maybe just touch on our view on fixed interest and the role it can play in a balanced portfolio?
Yeah, sure, Daniel. As David mentioned, we are a little underweight fixed income, moderately so. Fixed income has actually had quite an adjustment over the last few months. As David mentioned, it's been expected the Reserve Bank could be raising rates for a few months now, and fixed income investments like, longer term bonds went through an adjustment over the last few months in which prices declined to raise the sort of yield in the market on those securities. And so what we've seen is, say, for example, 10-year yields have risen 0.75% to almost 5%. And that puts them in a reasonable position to accommodate any, prospective rises in the cash rate by the Reserve Bank. At the moment, the bond yield, the 10-year yield's about 1% above the cash rate, which is quite a margin. Interest rates are not that low, so it's actually also quite possible that rates won't have to rise much further. The Reserve Bank may not have to raise rates a lot more. That's what markets are actually factoring in as things stand. But of course, they could have to go up a bit more than we think. But even with that, that gap to the bond yield puts the bond market in a reasonable place because provides some cushioning that adjustment's already occurred. And, if we don't see too much of a change, what investors will be faced with is yields which are quite good. Yields in the order of 5% are pretty decent, and that's a reasonably attractive proposition. The reason we're a little bit underweight is there's just this little risk around with the RBA in this phase of raising rates, which we're not seeing abroad, but we do have here. So just to be a little bit on the cautious side, but aware as well that there has been quite an adjustment already.
All right, now finally, David, alongside the more, I guess, traditional asset classes of equities and fixed income, we also see a valuable role for alternative investments as well. Could you maybe just provide a little bit of an explainer on alternative assets and our view in that area, please?
So we are overweight alternative assets, and that's a fairly broad opportunity set in terms of what we allocate to. We really see the role for alternatives at the moment as both a return enhancer and a diversifier in terms of potentially diversifying portfolios against some of these tail risks that people are worried about. So the sort of things in alternatives, from our perspective, look at both growth and defensive alternatives. On the growth side, we still like private equity, particularly domestic mid-market private equity. So there we're looking to get exposure to a lot of emerging, fast-growing companies. We still think there's lots of companies in Australia with very good long-term growth potential. So from that perspective, we like the private equity asset class in Australia. Also real assets. We think with inflation likely to be structurally a little bit on the high side versus maybe the last 10 years or so, with assets like commercial property, infrastructure, we think deserve a place in well-diversified portfolios. And on the more defensive side of the ledger, in terms of some of this sort of tail risk hedging, we've had a position in gold for quite some time, physical gold through ETS. And we still think with the world uncertain, even though our core view is pretty benign, there are risks out there. We still think physical gold is quite an effective tail risk hedge. So we still have a position in gold ETFs to broaden out the diversification potential of our portfolios.
Alrighty, that was very helpful. Thank you both, Tony and David, for sharing your views this morning. Very insightful. Now we'd love to address some of your questions that we've hopefully been receiving on the call.
Awesome. Thanks for that, guys, and the insights we've provided. Thank you for all those who have submitted questions so far on the call as well. I might just kick it off with one for you, Tony, if that's okay. Could you maybe just touch on the improved global economic outlook that we mentioned and that was underpinning, I guess, the overweight view to international equities as well?
Okay, yeah, certainly, Daniel. The global outlook. Last year, what the world faced was some headwinds to growth. We had, in particular, the rise in tariffs in the United States, and also an increase in uncertainty more generally that affected businesses and households. What we found is that actually the world coped with all of that a lot better than feared. When it came to the tariffs, American companies became a lot more productive. So it had less impact on production and inflation. And outside of the US, other countries didn't retaliate with tariffs of their own so much, and were able to redirect some of their trade. So that was managed quite well. And I think the uncertainty that we've all had in the past year or so, people seem to be living with and continuing to spend. So the world got through, and this year actually there could be more tailwinds than headwinds, which is it's a lot more positive. What we're seeing is more fiscal stimulus entering some of the big economies this year. In the US, it's a result of the president's budget, which he had approved last year, but which will run to the latter part of this year. And in that budget, there are income tax cuts on categories like overtime, earnings and tips. And there are also incentives for businesses to accelerate investment spending and there's lots of other elements as well. And then if you look outside the US, in Europe, in Germany in particular, there's going to be a lot more spending on defence and infrastructure, and that will actually happen over a number of years, but it'll impact this year. And then even in Japan, where there's a new prime minister looking to cut taxes, there will be stimulus there. So that's pretty supportive. And then the other arm of policy, monetary policy, we've talked in our earlier conversations about the Fed projecting that they will ease policy a bit this year. In the rest of the world, in Europe, there was an easing through to the middle of last year that is probably still stimulatory. And what's helpful all around there is that inflation is just not as high as it was. So there is this room to be stimulatory. And then over and above that, we've got this revolutionary
artificial intelligence investment boom going on. And that's not just driving massive investment in America itself, but around the world, companies are digitizing and modernizing, even here in Australia, which is affecting the investment. So there's a lot of supportive things going on this year, which should be helpful, quite a bit different to last year.
Awesome. Thank you. Now I'm seeing a bit of interest in currency. That always tends to be a little bit topical. David, I might throw to you on this one. We have obviously seen the Aussie dollar move a bit in recent weeks. Could you maybe just talk about your view on the Australian dollar, whether or not that's influenced the asset allocation strategy as well?
Yeah, sure, Daniel. So currencies do influence investment outlooks a number of different ways. And you're right, the currency, at least in terms of that Australian US dollar cross rate, the currency's been pretty strong over the past 12 months after having been under pressure for a number of years. So we're back at sort of around that 71 level, which is still not particularly elevated. So we still think, as a base case, it's always hard to forecast currencies, but still our base case assumption would be the currency in terms of the $8 US dollar, the $8's got a little bit of upside. Economists have various models of fair value, and I take those with a grain of salt, but some of these models are suggesting sort of 72, 73 as fair value. Others have the currency quite a bit higher than that, potentially. And you do find that currencies tend to trend. So we were in a sort of a downtrend there for several years. Now we look to have gone into an uptrend. So quite possible that that 72, 73 fair value level could get breached over the next 12 months. There's probably an additional overlay with respect to what's going on with US, let's call it the policies of the Trump administration, that could also be potentially pushing where the Aussie dollar might go versus the US dollar even a little bit higher in terms of beyond where those fair values are, in terms of just uncertainty around what the US is doing and the need to diversify out of US dollars. So what's all that mean? Well, it probably means that we think it's a worthwhile exercise to do a little bit of hedging with your international equity portfolio. Not fully hedged, but you can get a fully hedged version of a lot of different international managed funds now. It's relatively cheap, very liquid, very efficient market. So from that perspective, we think roughly a third of your international equity market, you could consider some hedging there, just to dampen that potential drag from a stronger $8 on foreign equity returns. So from that perspective, we're thinking that that's worth doing. Obviously, the other consideration is, while it dampens potentially foreign returns if you're not hedged, it's also a little bit of a drag on our potential earnings growth as a market. A lot of our big companies earn money offshore. So that's a little bit of a different consideration. That's in part perhaps why we're not that bullish on local earnings growth, which you are getting that drag from the Aussie dollar potentially, albeit we have got good commodity prices, and that's certainly helping. So lots of moving parts there. It's a pretty complex decision in terms of what to do with the currency. But the base case is Aussie dollar's got a little bit of upside, we think, against the US dollar. So we're doing a little bit of hedging at the margin on those foreign equity portfolios. But obviously currencies are difficult, and we're sort of implementing those hedges at the margin rather than across the board.
Yeah, awesome. Thank you for that. Now, Tony, I'll throw back to you again as well, if that's okay. We mentioned that we are still underweight in fixed income within the asset allocation, but we have seen bond yields move higher in recent months. So can you maybe just explain this view a little bit more in the context of that?
Yeah, certainly, Daniel. I think it just comes back to there being a bit of risk still with interest rates trending up a bit here, at least at the moment, with the RBA raising the cash rate. We don't know where that will eventually settle. Markets think there won't need to be a lot of increase. That's, I think, due to the fact that spending by households in particular seems to be quite sensitive to interest rates, given the cost of living challenges that everyone has. And so that's quite logical. But on the other hand, what we have seen over the latter part of last year is a pretty broad pickup in both inflation and growth. And sometimes managing that or containing that takes a little bit more effort. So with respect to inflation in services, I know a lot of people will be feeling this. Prices there rises picked up. In housing, if people are buying houses, that's picked up. Also, just buying goods, durable goods, picked up. And then the spending, it's a broad-based improvement across consumers, on housing, and by businesses that's gone on as well. So we just don't know what that will take, but we're just staying a bit cautious there. The other element that's going on a bit as well globally is that yields are rising in some important places. In the US, yields have been pretty stable for the past year, but in Japan and Germany, they've been trending up a bit, partly because of this fiscal expansion and a broader concern that since the pandemic, government deficits and debt have been a bit higher, and investors are a bit wary about the sort of yields they need to compensate for that additional debt. So that's not a dramatic development. It's more happening incrementally, but it's another sort of consideration to being a bit cautious still.
Yeah, awesome. Thank you. And now, David, I might throw back to you for this one, given that you touched on it a little bit in the video. We've had a question on private credit, and that seems to be fairly topical. So what is your view of it as an alternative investment? What role can it play in a portfolio? And given the media attention that we have seen, I guess, can we see it as a safe asset class for investors?
Yeah, it's an interesting one. And anyone who's read the Financial Review over the last 12 months would have seen quite a lot of column inches on private credit and potentially things that might go wrong there. It's a relatively new asset class in some senses. In some senses, it's been around for private lending has been around for thousands of years, but it's particularly it's been democratized or broadened out since the GFC. As often the case, it started really in terms of global private credit. Australia's maybe a little bit later to the game, but certainly in the last 7-8 years, you've seen growth in private credit in the domestic market. What's the underlying driver of this growth? It's really, I think, really the core issue here is the banks are lending less to businesses, particularly certain types of businesses, because the capital charges post the GFC are much more onerous on lending to businesses in terms of having to provision more capital for your lending book. Banks just prefer to lend to home buyers in terms of mortgages. So that's really why private credit essentially has grown quite rapidly. So I don't think it's a bubble. Having said that, I think in any fast-growing asset class, you'll find that there's been some poor decisions made. I think particularly in respect of the US, often you find when the tide goes out eventually that US financial engineering has probably gone too far into one direction. But I think it's a valid asset class. I think it's here to stay. We're probably more inclined to focus on the more vanilla lenders in the domestic market. Even within Australia, you can have a range of expected returns in private lending from 8 to 15%, depending on what you're actually doing. We're prepared to look at the full spectrum, but I tend to think that for most of our clients, down at the 8 to 9% area is where we typically want to play, rather than the 15%. So we think simple, prudent private credit funds are worth the place. The returns are good at that sort of 8 to 9% level. Big premium to public credit market. So yeah, it's always a case of doing your due diligence and not getting too far out the risk spectrum for most clients. But I do think private credit is going to continue to grow, and I think it's a valid alternative investment alongside some of the other ones I've mentioned. So yes, we're exposed. It's a fairly moderate exposure, but we certainly look at it and think it's worthy of a place in most investors' portfolios.
Yeah, awesome. Thank you for that. It is definitely one that has gotten a bit of attention recently. We have answered a few questions, so we might have to wrap it up there. But I appreciate everyone. Thank you everyone for joining this morning. Appreciate your attention. If you did have any interest in anything that we discussed on this call, or you would just like a copy of the asset allocation outlook document that I referenced at the start of this, please feel free to reach out to your advisor and they will help you out. But otherwise, as I said, Tony and David will be doing a national tour in the coming weeks, and so hopefully we'll be able to meet some faces there and get to know people. But otherwise, thank you very much for joining this morning. Thank you, David and Tony, for giving us your time, and we look forward to hosting you again soon.